Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
The man I'm about to interview requires no introduction. Meb Faber of Cambria Investments also has his own podcast, of course, the Meb Faber Show, joining us from sunny Manhattan Beach, California on this Monday in June. Meb, first of all, thank you very much for coming on and welcome to the Contrarian Investor Podcast.
Great to be here.
It is great to have you. The pleasure is mine. And I don't have anything scripted or anything. Neither of us know really where this is going to go. So let's just start. What's your view on the economy, on markets? Let's start there.
People are often surprised when I say this, but this is about as good as it gets. And what do I mean by that is that, particularly for the youngins out there, the last 15 years have just been a romping, stomping good time on par with some of the best bull markets in history. And if you characterize the post-2009 period, there's really only been three other periods like it in terms of magnitude of gains. So we've had a 10-bagger on U.S. stocks since 2009. So you had 100 grand then, you got $1 million now. Congrats. But really, that's only happened on a rolling basis three other times in history. The roaring 20s of 100 years ago, the nifty 50 period, and then, of course, my favorite bubble, the internet bubble. And I was just back at Virginia for my college reunion. I graduated in the year 2000, so marking that period in investing. And this period, the last couple of years, has definitely felt a little similar in some ways. But the whole point being is that it's been an exceptional period for U.S. stocks. Now, if we know anything about markets, this is a very technical phrase, but the good times often follow the bad and vice versa. And so we've had a pretty great party for a long time. And, it doesn't mean that stock market has to crash. It doesn't mean there's going to be a depression. It doesn't even mean that they have to go down. It just means on average, they've gone up a lot and are getting to the point where they're expensive in the U.S. They're getting to the point where everyone owns them and getting to the point where everyone is all in on U.S. stocks. So that's kind of the setting the table for where we are in 2025.
Yes, indeed. And it's been a volatile time here. Trump, tariffs, all this stuff. But we find ourselves right near, close to record highs for the S&P 500 and the NASDAQ. So what is your most contrarian take then on this whole situation?
Well, I love that question because I have a Twitter thread called, what's a belief I hold that 75% of my professional investing peers do not share. And I think we're over 20 tweets in the thread now. But if I had to say the one that really distances us from other professional allocators in the U.S., it's that everyone's all in on U.S. market cap stocks. And you can look at not just retail, but institutional charts like percentage of households' wealth in stocks. And that just means U.S. stocks. No one owns any foreign or, God forbid, any emerging market stocks. And it's the highest level it's ever been. And if we know anything about these types of charts historically over the last 70 years, is that, it's a good indicator, sentiment indicator in the opposite direction. So when no one owns stocks, it's usually a great time to be buying them. When everyone owns them, it's usually the opposite. Now, putting it in valuation into perspective, if we look at like a 10-year PE ratio, broad market cap U.S. stocks, 18 to 22, somewhat reasonable valuation. In the U.S. has been as low as 5, has been as high as 45, in 99. in December 99. And this is the Shiller PE ratio. And so the US today, what, 36? So high, not as crazy as it was in 99, but not good. But the beautiful idea, the beautiful setup today is the rest of the world is totally reasonable. There's many countries out there that are cheap. There's many countries that are screaming cheap. And so if you and I had sat around, talked about this in December, talking about the new year, looking out to 2025, we would have said, all right, I would have said the same exact things. US stock market's expensive. There's other things that look better. Small caps look better. Value looks better. Foreign stocks looks better. Emerging markets look better. And here we are where you kind of have these situations where investing, can turn on a dime and you kind of blink and all of a sudden foreign stocks, emerging markets are outperforming the US by 10, 15 percentage points. And the cheapest of the cheap, and we have an ETF that does this, are outperforming US stocks by about 30 percentage points. So long forgotten countries that no one wants to invest in, are having a really spectacular year. And historically, that's been a coin flip, U.S. versus foreign, but we've had arguably the longest period ever of U.S. stock outperformance versus a relative asset allocation portfolio, not just in terms of absolute magnitude, but also years in a row. It's something like 14 out of 15 years. We wrote a piece called The Bear Market and Diversification, and I think I'm ready to pin this year. The bull market and diversification has begun, where you start to see other assets outperforming SPY.
Interesting. But are they all correlated? I mean, and ultimately, doesn't this all rely on the US consumer for stocks to go up, whether they're European, Chinese, Australian, whatever?
We often tell people we love our little polls on Twitter, and so we ask questions and kind of gauge where people stand. And people forget. So the U.S. is what, 2/3 of world market cap as far as stocks. So the largest stock market in the world. It's 10 times bigger than number two. But that's not true when it comes to economy. U.S. as a percentage of world GDP is only 1/4. And I think if you were to ask most people, they would probably say, yeah, U.S. GDP has probably got to be, I don't know, 60, 70% of the world. And it's not. And it hasn't, been any bigger than that for a really long time. And in fact, so we're writing a book on the kind of history of stock markets. And, U.S. hasn't always been the largest stock market. For 200 years, there was no U.S. stock market because the U.S. didn't exist. And then, in the 1800s, UK was the biggest stock market. And even in the 1900s, US wasn't the biggest in the beginning. And for a while, Japan was the biggest. And so these countries have a way of, going in and out of favor. That having been said, particularly this cycle and particularly the tech companies have had exceptional growth, exceptional performance and earnings. And so some of the performance is certainly warranted. But in a world of 40 plus investable countries, you could very easily make the case that, hey, there's a fun stat I have that we posted on Twitter that we said European banks have outperformed the Mag 7 over the last 3 years. And I feel like that would surprise people.
Yeah.
So, I think this potential reversion, we'll see how long it lasts, is something that could last years. On a lot of these regimes could be a decade or more. Who knows? The 2000 decade. So post my graduation was one in which, U.S. stocks underperformed just about anything in the world. REITs, gold, bonds, value, on and on. Small caps.
Yeah. Yeah. Any particular countries there that you're particularly bullish on?
So we send out this email to a list we have called the Idea Farm. And the Idea Farm goes out to, I think it's over 100,000 people. And it curates the top 2 or 3 investment research pieces we read every week, top 2 or 3 podcasts. And then it also does a quarterly valuation update that looks at 45 countries around the world across 4 measures of valuation. So not just 10-year P/E ratio, but also price to book, price to cash flow, dividends. And we've been doing it for, I think, over a decade. And one of the interesting parts was the U.S. was, for the first time, and I think the entire sample, the most expensive country in the world as far as the stock market this past December. So for a couple of years, it was up there. India, Denmark were both kind of bouncing around. Denmark, highly concentrated in Novo. India, just because of the massive outperformance it's had, particularly starting to disperse from China. There was a long time when China and India just kind of moved together, and then last couple of years that's decoupled. But on the flip side, on the cheap, all sorts of stuff. So in Latin America, you got things like Colombia and Brazil. You still have a lot of Eastern Europe and emerging Europe. I think Poland is up like 40% this year or
Yeah.
50 or something incredible. Um, but then you got countries where I think a lot of people would give them quite a bit of pause. If you say, hey, listen to Meb on this podcast, and he said, go buy Turkey and Poland and Colombia and, Korea and Indonesia just to mix it up, you'd say he's crazy. But I think the average allocation to emerging markets in the United States is around 3%, which essentially rounds to zero. But as far as market cap, the starting point, the John Bogle Vanguard starting point should be a third in foreign and emerging. And you could make the argument on a valuation basis that it could even be more than that. I mean, if you GDP weighted stocks, the US would only be a quarter. So the first comment would be just foreign developed, foreign emerging indexes. We run shareholder yield strategies in these regions. And the metrics are very compelling. So very low valuations, great growth, great cash flows, returning cash to shareholders through dividends and buybacks. And so I think the setup for value everywhere looks great. It particularly is doing well ex-US this year. So value US isn't, really distinguishing itself that much, but value globally is having an absolute face ripper of a performance this year.
Yeah. But you say there's more upside there, you think?
You think so? A lot of these countries are single digit PE ratios, and you have a scenario where even the ones that are reasonably priced, I mean, there's 10, 12, 14 PE ratios, like that's a third of the US, right?
Yeah.
So, US being mid-high 30s is quite a bit more than a lot of these. And so just about anywhere, you could kind of close your eyes and throw a dart and end up in a pretty good place. And that's the beauty too. Like I think a lot of investors, they say things like, well, I'm worried about China, or I'm worried about XYZ. Well, invest in a basket of these countries, and I think you could close your eyes, hold your nose for a decade and probably be in a pretty good place when you look back on it.
Mm-hmm.
But even places like UK, I mean, it doesn't have to be Norway.
Yeah.
These are not little tiny third world countries.
Right.
A lot of the foreign developed looks great too. And I think, when we see in markets the mood shift just a little bit, you can see flows accelerate into certain places, capital moves around the world, and all of a sudden, some of these markets could be doubles or triples, in the not too distant future.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
But for the more longer term, a lot of these, you need economic growth, right, to drive. I mean, they're not directly linked, but they are linked somewhat, growth and economics, right? So you need economic growth. And a lot of these countries, to have economic growth, you need a growing population. And I looked at, there's a recent book about the population bomb. Maybe it's not recent, but it's been getting a lot of press. And a lot of these countries, especially in Europe and throughout the developing world, actually, developed world, are facing demographic issues here and are not going to be able to grow and are not going to be growing their populations. Does that concern you at all, or if you look at the long term, not so much?
My biggest takeaway when we talk about investing in globally, is the world is a very interconnected place. If you look at, one of the reasons that I think is faulty that people use they say I invest in the U.S. and the U.S. the companies get a certain percentage of their revenues from abroad. Therefore, I'm diversified. Right. I say, well, that's also true elsewhere, right? If you invest in other countries, they also get, and it's actually, the U.S. is the lowest in the developed markets, a percentage of revenue from abroad. So you invest in Japan and UK and elsewhere, they also get exposure to the U.S. consumer, right? And so it's a very intertwined world. And I said this like a year or two ago, I can't even remember now. The months are peeling off so fast, but I said, I don't know why everyone assumed that the long-term innovations in science and AI just have to come from Silicon Valley. Now they have, and it's, look, the US has been exceptional, but I was like, you could see a world in which some of the big AI developments come out of China or come out of somewhere in Europe or Africa, Latin America, who knows? And then you had that DeepSeek kind of jiggle where all of a sudden people are like, oh my gosh, this
Mm.
China's got this amazing AI. Like you just don't know. And I think the long arc of history and innovation, if you were to go back and say, hey, what country held the crown over the years as far as like the dominant superpower? You got all sorts of different names you could put in there. Portugal and Spain, you could put in UK, you could put in China, you could put in, Mongolia, on and on. And just because the US is here and now, I don't know that necessarily will always be the case. And so I love to have exposure to everything. And the beauty of diversifying globally is you don't have to make that bet. And historically, not diversifying globally, even during the 20th century, which was an incredible story of U.S. exceptionalism. In the last 12 decades, the U.S. stock market has only outperformed an equal weight or a global weight of other countries like 4 times. I think most people would assume it's much higher, but I think being diversified is a thoughtful approach in an uncertain world. Like, talk about
Mm.
population and demographics. And I mean, I think if you just close your eyes and bet on demographics, you would just put a bet on Africa and go away for 50
Yeah.
years. But you never
Mm.
know. I mean, the
Mm.
robots come take over and, uh, who knows what's coming. It's going to get real weird real quick, but I'm ready for it.
Yeah, where do you stand on the AI stuff, and have you found any interesting investment opportunities there?
I found a lot of curiosities.
Mm.
I spent the weekend. There's a fun new music app. I think it's called
Mm.
Suno, where you could prompt it and it'll write a song. And the song is like literally 90% as good as what you hear on the radio, but it's tailored to your lyrics. And so we spent the day yesterday with my son and other friends, writing funny songs about our relatives and friends and everyone else. But it's catching up really quickly on a lot of things. It's great. I think I'm going to read you a stat because I tweeted this out about a couple weeks ago. It's from the Wall Street Journal, but talking about a little bit of the cultural shift of the U.S. exceptionalism. So we do need to give a little hat tip to this, but it was something like, over the past 50 years, the U.S. created from scratch 241 companies with a market cap of more than 10 billion, while Europe has only created just 14. So 5% as many, an astonishing
Mm.
stat. In Europe, VC capital, tech investment is a fifth of U.S. levels. A typical company in the top 10 publicly listed U.S. firms was founded in 1985. In Europe, it's 1911.
Mm.
Europe has a larger population, similar education in the U.S., but only 4 of the top 50 tech companies are
Mm.
European. So you do see some of these disparities. Now, some of those stats are definitely simply market capitalization because the stocks have done really well, but some of them
Mm.
is very much just they've been exceptional. Now, I think this is well known. I think everyone kind of gets that part. And so the question is, will they be able to match the expectations and growth? It'd be fun to watch at the scale of
Yeah.
Nvidia and Apple. It's pretty amazing because those Mag 7 are bigger than like the next 7 country stock markets combined or something. It's
Yeah.
astonishing.
Yeah, it's crazy. But one of the reasons people cite is that these other countries don't have the governments or whatever, that they aren't set up to foster innovation. They're much more safety driven, and yeah, they're not set up for people to take risks, and they don't reward people for taking those risks. They tax wealthy people much more than we do, and uh, yeah, most places
Well,
at least.
one of the insights is I do a lot of startup angel investing and have invested over 400 companies and have seen a lot of really phenomenal companies ex-US. And
Mm.
you're starting to see the what I call sort of the Silicon Valley model spread around the world. And so you had a number of these incubators, and every year there's more and more alumni that either have moved to the U.S. or lived elsewhere, and you start to have these accelerators start to pop up. And so we did a series on the podcast, man, I don't know, it's 4 years ago at this point, and we used to talk a lot more about these startups, but there was two. One was said, hey, look, because the seed companies and the startups eventually become the public companies 3, 5, 10 years later. So there's two trends we wanted to talk about. One was investing in space. So we
Mm,
said, historically you have all these mega aerospace companies, the Boeings, the Lockheeds of the world, but we started to see all these tiny companies that started to have real traction, real revenues, real milestones. And then the other one we did was about Africa. So we started to see a
mm,
lot of really interesting companies. I think if we were to do two more, we certainly would have talked about Latin America and
mm.
Asia, Asia specifically being India, Pakistan, Bangladesh, seeing some amazing startups and companies. I think it'll be fun to watch, but there's definitely some trends that the people look to the success of that model, and I think it's replicable. I think
Mm.
it's something that the rest of the world hopefully will embrace. And that having been said, I was listening to a podcast with our friends at the compound, and there was some stat where it was like they asked people in Japan and Europe and in the US if it was a good idea to start a business. I'll get them wrong, but directionally correct. In like Japan and Europe, they said that like 10% of people said it was a good idea. It might have been five. And in the US, it was 95%. So there's
Yeah.
something in the water, we're all just a little crazy, I think. I don't know
Yeah.
whatever it is, but it's certainly there is a little something. But hopefully, I think it'll spread around the world.
Yeah. And it's not like the other countries have been complete laggards. I mean, the Walkman came from Sony in Japan, right? I mean, the Russians put up someone in space before we did, right? So it's there's innovation elsewhere. It's just a question of, I guess, being able to invest in it and for the countries getting mature enough and at the right time, I guess,
Yeah,
right?
yeah.
Um, that's really interesting. Going back to the diversification, have you found any country that is not linked to the US or that is that and yeah, because that's kind of the holy grail, right? Like to find something that's uncorrelated to the S&P.
Um,
And yeah.
Yeah, so we've written a bunch of papers thinking about this sort of topic, one of which was talking about what happens when the US stocks do very poorly in terms of worst month, in terms of bear markets. And this year I think is a perfect example, as was COVID, where you say the things that you would expect to not do well, didn't do well. So like you wouldn't expect if the US stock market goes down 20% next month or goes into a 50% bear market, you wouldn't count on or expect foreign stocks and emerging markets necessarily to do great, right? Like they're probably
Right.
going to be down just as much because they're stocks and they're beta and they have the same general exposures as US stocks do. And things like REITs, traditionally, same thing. They are US stocks. They're in the real estate sector. Traditionally, they don't do any better. Then you have some things like fixed income, bonds. Bonds historically, on average, does okay during down markets, but not always. And if you look at the beginning, I think a lot of people mess this part up. The beginning of the 20th century, bonds consistently didn't help hedge in the bad times, but often over the last 50 years they do. But if you think back to 2022, they didn't, right? They were just as bad
Right.
as
Right.
stocks would have been. Then you got other stuff like commodities. Commodities is like a coin flip. Like who knows is going to
Mm.
show up? Gold, it's like it could do great, it could do terrible. Um, but so there are some other things and styles and strategies. I think value investing often helps, particularly in times like now or late 90s when the market cap weighted index is expensive, but things like small cap or value are much, much cheaper. It's not a guarantee. It doesn't mean that it's gonna do well, but it should. And then you have things like trend following, managed futures. We love trend following. I think it's the premier diversifier to a traditional portfolio.
Mm.
And then lastly, of course, is something like tail risk. And, we
Mm.
have strategies to do all these things in ETF format. Tail risk, you can't say guaranteed, but almost by definition should do well. In our case, we're talking about buying puts on the
Sure.
stock market, but it's usually a cost, right? It's an
Yeah.
insurance type of thing. And most people don't want to pay up for that or don't certainly want to do it year after year. So there's a handful of things when you put together a portfolio, and it also depends on your time horizon. If you were to tell me, wait, Meb, actually, I'm just talking about the next 30 years or the next 50, I'd say, oh, forget it. Like, it's the valuations and everything washes out over that period. But if the path is the problem for most people, right? And so being able to sustain that 10% returns, that you're looking for every year, it's not 10, 10, 10 every year, right? Maybe up
Yeah.
20, down, +1, on and on.
Mm.
And so cobbling together those three main asset classes, global stocks, global bonds, and global real assets. Most people are hugely underweight real assets. So in
Yeah.
terms of tips, REITs, commodities, commodity equities, I don't think a lot of people know this, but gold outperforming U.S. stocks this century. I think
Mm.
REITs probably are still too. I'd have to look it up, but
Really?
they both of those have the last 25 years done better than U.S. stocks have. So a lot of these
Yeah.
diversifiers I think are important. People certainly start to pay attention to them when they're hitting all-time highs like gold is and
Yeah.
others.
Yeah. All right, Meb Faber, on the Contrarian Investor podcast, I want to take a short break and come back and ask you some more questions. One thing we have not yet discussed is tariffs. I want to ask you about that and several other things as well. We will first take a short break. If you are a premium subscriber, you will not get the break. Do not touch the dial. We'll be right back. In fact, we already are. Everybody else, to become a premium subscriber, visit the website contrarianpod.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack where you can sign up for the same prices, same benefits, same details, contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a Contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show.
Welcome back, everybody. Here with Meb Faber, a man who, as I said, needs no introduction. But this is the segment of the show where we ask our guests to tell us a little bit more about himself or herself and how they got to this station of their career and how they got into investing in the first place. Meb, out there in California, is that where you're from?
I'm a little bit of a mutt. I got a little Colorado. I got a little North Carolina mixed in. Still say y'all.
Nice.
Went to
All right.
college in Virginia, but been out in Cali for like 20 years now. So a
Okay. But
little
yeah,
bit of
so take
everything.
us back and tell us how you got into investing in the first place and what's happened to get you to where you are now.
I mean, it's easy for a lot of people to kind of look down our noses at the young speculators of today trading zero-day options and
Mm.
Dogecoin and everything else, because that probably would have been me. It was me in the 90s. It just was called CMGI and Lucent and everything else. But, I grew up during that great bull market, and so certainly was interested in stocks. So for me, Robinhood was E-Trade. and the trading things that everyone's doing today. We didn't have all the prediction markets and sports betting the same way that everything's been gamified today, but we still had biotech companies and internet companies and all the other ideas. I studied engineering and biology and thought that was going to be the path for me long term, but the markets seduced me a bit in the late 90s. I certainly was interesting, complicated, never-ending challenge and puzzle. And so, kind of career and hobby sort of diverged a little bit. And it had done some grad school in biotech, but started working for a biotech fund and then kept gravitating a little more quanti and eventually moved down to Los Angeles and start Cambria. And, thought this little startup in my 20s may have lasted a year or two. And here we are almost 20 years later. And I think we're just about 3 billion in assets and got 18 ETFs and a couple more coming soon. And it's grown up a little bit.
That's wild. That's great. Can you talk about the new ETF launches?
Yeah, our goal in this world of unlimited choice, we often say it's the best time ever to be an investor, but it's like going to the grocery store and there's like 400 types of cereal. It's like impossible to choose. And so what in the world does the world need any more ETFs for, or funds in general? And so we try to only launch funds that don't exist or we think we can do, quote, much better or much cheaper. All of our funds are cheaper in the category average, but better, of course, is subjective. But we're trying to only launch ideas that no one else has done. And so much of our world and industry is closet indexing, where people just launch copycat funds for much higher fees than Vanguard is charging. It's got to be backed by academic research. So we publish a lot of white papers and books and blogs and tweets and podcasts that kind of talk to some of these ideas. Some of it, not ours, some of it academic or practitioner research. But the big one for us is it's got to be something I want to put my own money into. And I think a lot of people would be surprised to know that the average mutual fund manager has $0 invested in their own fund. And to me, that feels unjust and unfair to go on TV and say, buy my fund. And then, people say, well, do you buy it? And they say, no, I don't own any of it. And so the funds range in strategies from very simple and kind of broad-based. We have some allocation funds that are kind of all-in-one portfolios to things that are much more niche and specific. I mentioned we have a fund that invests in the cheapest countries around the world. We have a global deep value fund. Our kind of flagship on the equity side is called Shareholder Yield. If you guys want a Shareholder Yield book, you can download it for free online, along with some other books. And the two big portions of our brain are focused on value investing on one half and then trend on the other half. And so we have things like managed futures and trend and tail risk. So it goes from the kind of the Raisin Bran on the cereal list all the way to, Frosted Flakes and all sorts of crazy stuff too. We have a couple more funds coming out by the end of the year where, the focus on the beauty of the ETF is it's hugely tax efficient. And that decision alone in a taxable account probably saves investors 1% a year or more relative to their mutual fund cousins, which is kind of why you're seeing the whole world move to the ETF structure. So we think a lot about, implementation and taxes and things like that make a big impact over time. We all love talking about the sexy side of what's going on in markets and the Fed and everything else, but the boring old topics of taxes and fees can be just as impactful over the long term.
Yeah, I see here you have a Cambria tax-aware ETF, which has not started trading yet, has it?
Well, so there are two parts to that. One, the fund did launch in December, and the ticker is TAX, so it's easier to remember, TAX. And going back to your initial question, this might actually take the cake. Whereas I said, everyone's all in on U.S. stocks, and the non-consensus view is diversifying globally or away from market cap. This one may, I feel like tweak people a little more and set them off, trigger them a bit, which is taxes targeting stocks in the U.S. that pay low to no dividend. So there's nothing that people love more than passive investing into high yielding companies. And that's all well and great, but I don't think most people actually understand that to get to the 10% historical yield you have in stock, or historical return, you have to reinvest your dividends. You can't go spend them. And it's not just like you're getting some, weekly allowance or quarterly allowance from these stocks. Like the stock price goes down by the amount of the dividend. And I don't think most, particularly individual investors, understand that. So we wrote a paper a long time ago. Nobody read it because it was about taxes and dividends, and said, if you're a taxable investor, so in a state like mine or yours, and you pay a lot in taxes, the last thing you want in a taxable account is dividends. God forbid high dividends or extremely high dividends. So there's zero people on the planet that are going to agree with me on this, but you can mathematically prove that if you're an investor and you're in a taxable account in equities, a strategy that avoids dividends, so zero or near zero dividend yield, and has the same return as, say, the S&P 500 or something like that, if you can match the return, you have a higher after-tax return. Like that's just the laws of math, and so, but will anybody on the planet say, I'm hot and bothered, I want a no yielding fund? But guess who gets it? Berkshire. Warren Buffett. Berkshire hasn't paid a dividend pretty much ever, but they do buy back a lot of stock, and so I think this narrative, but everyone in their mind has these visions of passive income sitting on the beach and Cabo and drinking pina coladas and letting those dividend checks roll in, when in reality, you're probably better off without them, which I think is non-consensus view.
No, I put out a tweet on this a year or two ago, actually, on this exact premise, because the dividends count as income, whether they're reinvested or not. So it's a taxable event, unless of course, you have them in a IRA or something. And it also, like, there's other reasons for why. I mean, Buffett says they should be reinvesting the money in the business, right, and not paying out people to reward them. And it's not good for the balance sheet. It's not good for the capital structure, et cetera, et cetera. So there's certainly a lot to be said for that. And a very, very interesting. I had a question in there, which I forget. I have now escapes me, but
Buffett is great. Buffett has written more about, and so this goes back to our topic of talking about capital allocation and shareholder yield. So the thesis of our book, when we talked about shareholder yield, is called A Better Approach to Dividend Investing. And so we were talking about how actually there's been this giant shift away from dividends towards buybacks in the US. Yeah. And the reason being is they're more tax efficient and they're more flexible. And on top of that, if the stock is trading below intrinsic value, you get a big arbitrage between buying a dollar for 80 cents. No one talks about this more than Buffett. Almost every shareholder report he has in the yearly annual reports, he talks about buybacks. We use a quote from him from the 1980s talking about buybacks. And Berkshire, we said this during the pandemic. I said, you watch. Berkshire may not go out and do, everyone's always waiting for him to elephant hunt, go buy big companies. And I say, you watch, he may just back up the truck on buybacks because he has an objective floor. He said, if Berkshire gets to 1.2 times book, we'll buy back shares. Now it's having a great year. I think it's up around 1.7 times book. And guess what? He's not buying back any shares, and he's got some of the highest cash levels he's ever had in history. So I think nobody gets it better than Uncle Warren, and it's a thoughtful way to think about it. It's hard to go back to thinking about it in any other way after you take that pill.
Yeah. And it's interesting. You would think that technology growth companies are one of the definite that they don't pay dividends, but a lot of them do now. And looking at the portfolio of this tax ETF, only 20%, 21% is in technology.
Well, the funny thing about the sectors is the sectors are also time varying. So if you look at our shareholder yield funds, for example, their value strategies, the U.S. fund has like almost nothing in tech stocks. But the emerging market fund, it's long been the number one or number two sectors. So the opportunity set is different. Now, part of the key consideration in the U.S. is the tech companies in particular, in my home state of California, the average stock is a net issuer of shares. So the buyback component, you can't just do buybacks. You have to do net buybacks, net of share issuance. And a lot of companies have this terrible habit of this long bull market where the boards just approve all these giant pay packages and the CEOs love to have C-suite option-based compensation. And all of a sudden, some of these tech companies are diluting shareholders by 3-5% per year.
Yeah.
And so you get into this problem where historically investing in these companies is a terrible,
Yeah.
terrible, no good idea over time. And that usually shifts in the business cycle, right? You get a nice
Yeah.
fat bear market and things shift a little bit, but focusing on companies that are thoughtful on capital allocation. There's a great book called The Outsiders that
Mm.
talks about this, some case studies that is a
Mm.
great read.
Yeah. Okay. I mentioned tariffs at the outset, and we didn't talk about them yet. So tell me, what are your views on tariffs? And the fact that you haven't mentioned them leads me to believe that maybe you don't view them as the world-ending thing that a lot of other
People,
people do. Go
people,
ahead.
people used to all the people love to ask, what's the catalyst? So late 90s, you're like, what was the catalyst that caused uh, that bubble to pop? And people would point at a few different things, and it's usually somewhat more obvious in retrospect, or at least what we attribute it to. And so if you and I were sitting around, having cheersing each other at New Year's last year, and I would have said, hey, look, I think the market's expensive, market cap weight, second most expensive it's ever been. The US is the most expensive country in the world. We think, it's much better. Foreign stocks look better. Emerging looks better. We didn't even get into bonds and fixed income. That's a whole nother topic. And then you fast forwarded, and then the US dollar is expensive on a purchasing power basis to a lot of the major pairs. And you fast forwarded almost halfway point this year, and you just didn't even look at any of the news and said, okay, US stock market's roughly flat. Foreign is outperforming by quite a bit, and the foreign really cheap emerging market global stocks are up 20-30 percentage points. You would nod your head and say, oh, okay, that makes sense. You say the dollar's down a little bit, so that's been a tailwind for some of these foreign companies and stocks. You say, okay, that seems totally reasonable given where we are. US stocks taking a breather relative to the rest of the world after stomping them for 15 years. And never once did we mention the word tariff. So I think a lot of the things that were in motion today were already in motion then. And I think it doesn't really have anything to do with tariffs. Now, any given day, the news flow is clearly shifting these markets quite a bit, as you've seen over the last few months. But at the same time, a lot of these regimes play out not just on days, weeks, months, quarters, but years, decades. And so I think we could look back in 3, 5, 10 years and be saying a similar thing where, hey, wow, we look back and can kind of mark the shift to foreign and emerging and other. And by the way, the hilarious part about this entire discussion is our largest fund is a U.S. stock fund. So I'm not talking my book here, listeners. Like, nothing would benefit me more than the U.S. stock market just chugging along. It's like a third of our overall assets. But I do believe that value small caps small caps have been atrocious in line with foreign and emerging. They're not getting the outperformance this year that foreign and emerging are. But we also are bullish on those as well relative to market cap weights. But they're even worse than the large caps this year.
Yeah, they've been awful. Yeah. All right. Is there anything that concerns you about like in the economy, perhaps, or anything else?
Yeah. So I'm writing a new book on kind of history of stock markets and returns, and every decade there's something to worry about. One of my favorite charts is the 100+ year. It's usually just the U.S. stock market. We're writing it on global, but it shows all the crisis events: Pearl Harbor, World War II, Spanish flu, on and on, right? And so every year there's something horrific, terrible, no good that happened, and yet the stock market, goes up roughly 10% a year over this period. In 25 years, you'll 10x your money. In 50 years, you'll 100x it. Like, it's incredible. Like, despite all the terrible things that happen. And so, there's always stuff to worry about, I think. I'm like, there's a lot of the things that everyone talks about and it's well known. I mean, we got 2 wars going on currently, at least a handful of civil wars and, potential things that are all geopolitics is always a mess,
Yeah.
and so I'm sure the robot rebellion will come soon, like whatever it may be. I don't know. But historically, capitalism and free markets finds a way, and it's paid to be a shareholder and compound over time. Stocks are unique, amongst a lot of traditional assets that companies can reinvest in their growth and business, which things like bonds can't. So we're as bullish as ever, despite what's going to happen, what the news is going to say.
Oh, that's pretty contrary. No concerns about the debt ceiling or the U.S. debt and all those things that people have
I
been.
mean, markets have a way of figuring these things out. In the UK, they started to have some debt problems, and bond market said, you know what, like we'll show you who's boss, and yields started coming up, and then that'll topple leaders, that'll topple governments, that'll topple situations. I mean, I think the most obvious path, and this isn't popular, but allowing the U.S. inflation to run hot relative to growth is one way of reducing that debt exposure. Growing, is another one. But for hundreds and hundreds of years, we have history of inflations in currencies that don't exist anymore. Nobody's talking about the continental and the florin and everything else. So I think that's an even better reason to diversify globally, not just in terms of stocks, but bonds and currencies and everything else too.
Yeah. All right. That's a good way to close. Meb Faber, maybe in closing, if you can just tell our listeners how they can find out more about you, about your firm and your ETFs, and I will put all that information in the show notes as well.
Yeah, so day job is running Cambria Investments. So you can go to Cambria Investments or Cambria Funds, which is our ETFs website. You can find a lot of content, mebfaber.com or the Meb Faber Show podcast. Watch me pick fights on Twitter. Sign up for the Idea Farm, is our free email service that goes out once a week. And if you're ever in Manhattan Beach, come say hello.
Absolutely. Very cool. Thank you again to Meb. Thank you all for listening. And we'll be back again in a couple of weeks or so. Look forward to speaking then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.